The Super Bowl theory. When football meets Wall Street. Every February, investors and sport fans alike dust off one of Wall Street's most entertaining indicators, the Super Bowl indicator. First identified by New York Times sports writer Leonard Koppett in 1978. This theory suggests that if a National Football Conference team wins the Super Bowl, the stock market will rise for the next few years. If an American Football Conference team wins, the market will fall. It sounds absurd, and yet the indicator maintained an 80% accuracy rate through its early decade. The question is, does it still work? The past decade, a mixed scorecard. Let's examine the last 10 years of the Super Bowl outcome against NASDAQ 100. So when we look at our chart, we actually have, out of those 10, only 3 of them predicted it correctly. So as of February 8th, 2026, the year has just begun, so we won't know the full NASDAQ 100 return until December 31st, 2026. And that's Seattle Seahawks, a national team, won. So we'll see what happens this year. The indicator's recent performance, terrible. American teams won 6 of the past 10 Super Bowls, which should have predicted bear markets according to the theory. Instead, the market was positive in 9 of those 10 years. The only down year was 2022 when a national team, the Rams, won, the exact opposite of what the indicator predicted. In the last decade, the Super Bowl indicator was wrong 70% of the time. A coin flip would have been more accurate. The theories peak and decline. The indicator's accuracy has eroded significantly since its heyday. Between 1967 and 1997, it boosted a 90% success rate. From 1978 to 2022, accuracy dropped to 67%. Since 2000, it has been correct only 46% of the time. Recent data shows American team wins have corresponded with positive market returns 12 of the last 13 years, completely contradicting the original theory. The historical data does show some interesting patterns. When national teams have won the Super Bowl since 1967, the S&P 500 has averaged 10.2% gain. When the American teams have won, the average gain was 8.1%. Both are positive. Hardly the bear market the theory predicts for the American team victories. The psychology behind the pattern. This is where the Super Bowl indicator becomes instructive for investors. The phenomenon illustrates several critical psychological biases that plague investment decision making. Illusory pattern recognition is a tendency to see meaningful patterns in random data. Our brains evolved to detect patterns for survival, but this hardwiring becomes a liability in financial markets. The Super Bowl indicator is a textbook example of spurious correlation, 2 variables that appear related but have no causal connection. Research shows that stress and uncertainty increase illusionary pattern recognition. In volatile markets, investors become more susceptible to seeing correlations that don't exist. Confirmation bias leads to investors to seek information that confirm existing beliefs while ignoring contradictory evidence. Those who believed in the Super Bowl indicator during a successful run were likely to explain away failures as anomalies rather than evidence the theory was breaking down. Hindsight bias makes past events seem more predictable than they actually were. The indicator's early success led many to believe it had genuine predictive power, when in reality it was statistical noise that happened to align with market outcomes for a period. The Super Bowl indicator also demonstrates the gambler's fallacy, the mistaken belief that if something happens more frequently than normal during a given period, it will happen less frequently in the future. Investors might think an American team has won 5 years straight, so the national team is due. But each game is independent of previous outcomes. The real lesson, the Super Bowl indicator isn't completely worthless. Its values lie in what it teaches us about ourselves. The markets are driven by fundamentals such as earnings, interest rates, economic growth, monetary policy. A football game has zero causal impact on these variables. Yet investors consistently search for shortcuts, patterns, and signals that promise to give them an edge. The indicator's decline in accuracy coincides with the rise of algorithmic trading, passive index investing, and global capital flows, factors that dwarf any supposed correlations with the sporting event. Behavioral finance research consistently shows that investors who recognize their cognitive biases make better decisions. The Super Bowl indicator serves as a reminder to distinguish between correlation and causation, to maintain healthy skepticism about market folklore, and to focus on evidence-based investing rather than entertaining anecdotes. Don't let your portfolio play by outdated rules. Here's the uncomfortable truth. If you're basing investment decisions on folklore, like the Super Bowl indicator, what other outdated theories are quietly eroding your wealth? The financial world is littered with strategies that worked once but stopped working years ago. The problem is most investors don't realize when the game has changed. Your portfolio deserves better than stagnant theories and unexamined beliefs. It deserves a disciplined, evidence-based approach grounded in the actual market dynamics, not entertaining myths. The real question isn't whether the Patriots or Seahawks will win the Super Bowl. It's whether your investment strategy is built on solid fundamentals or crumbling assumptions. It's whether your portfolio is positioned for the market we have today, not the market of 1978. Contact us to review your portfolio. Let's identify the hidden biases, outdated strategies, and spurious correlations that might be costing you returns. Don't let superstition and stagnant beliefs end your financial game before the fourth quarter even begins. After all, in investing, as in football, winning requires discipline, strategy, and knowing when to call an audible. Thank you very much, and please share this with your friends and coworkers and neighbors. Thank you.